and welcome into the program. This is your Course to Retirement with Ron Courser, CFP Grand Rapids, your resource for a common sense approach to planning for your financial, investment, and retirement future. Ron, today covering a fundamental premise of retirement is that there is a distinct and very important difference between our income plan and our investment plan.
You know, there really is. Welcome to everybody listening to today's program. I'm Ron Courser with Cornerstone Retirement Partners. If things we've talked about or going to talk about here on today's show kind of tickle your fancy, as they say, and you need more information or want to talk, give us a call at 616-301-2581. That's 616-301-2581. Again, this is Cornerstone Retirement Partners. I'm Ron Courser. You can also go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you get the answers you need to make good financial decisions. Today's program, along with all the other programs on the blog, are available also on our website. And a lot of people have told us that's a great source of kind of going back and restructuring everything that they've thought about and think about, and just kind of a refresher course in financial accounting and investing. So I hope you'll take advantage of that. So there really is a big difference between an investment plan and an income plan. And it's so different that a lot of times it's hard for some people to recognize that. We've been raised with the idea that if we work for 20 or 30 or 40 years and save money, that ultimately we'll be able to retire in somewhat of a healthy, wealthy lifestyle and hold on to our lifestyle with the money we've saved over the last many years. And sometimes we think of, well, where I put my money, where I invest my money is everything. And when we really think through this whole issue of retirement planning, holding on to your lifestyle, which is really key in retirement, why would I bring up the difference between an investment plan and an income plan? Think of it this way. When you're working, an investment plan is nothing more than choosing certain mutual funds, stocks, bonds, what have you, to put your hard-earned money into, with the underlying assumption that over time it's going to grow. And that investment plan, that's the basic plan for everything. But when we get close to retirement or get into that thing called retirement, what is it we want our money to do? So think of it this way. While we're working or before retirement, we want our money to grow as much as possible with a minimum of losses. When we're in retirement, we want our money to provide us all the income we need to hold on to our lifestyle and do some enjoyable things in retirement. Now, those are really two different objectives for our money. They really are different, because one says, well, I'm just going to buy a certain kind of asset or stock or bond or mutual fund, and I want it to grow because it has to grow, because over time I'm going to need more money. The other approach is to say, look, I need what I've worked so hard for to save. I need that to provide everything I need now, not only for this week, this year, but over my lifetime. So the difference is critical to understand. So think about this way. An income plan is what creates an investment plan when you retire. While you're working, you're just dealing with an investment plan, large cap, small cap, mutual funds, things like that. But when you retire and you say, well, I need X number of dollars, I need $5,000 out of my investments every month to maintain my lifestyle on top of Social Security and a pension. How are you going to get that money? Where's it going to come from? And how are you going to avoid the biggest, probably the biggest risk in retirement is something called volatility. So you want your money to grow. You want your money to give you what you need. But I'm here to say that probably when you're working, volatility, when you're buying things, mutual funds, investing in your 401k, and you're doing something called dollar cost averaging, where you're putting in the same amount of money every month When the market's down, you're buying more shares. When the market's up, you're buying fewer shares. Over time, if you assume the market goes up 2/3 of the time, you hopefully have more money at the end of your working career than what you started. But when you think about dollar cost averaging, it works so well, and it's a fundamental rule of investing while you're working. It actually creates real serious problems in retirement. And this is why you have a fixed amount of money to retire in. What you need from an income plan is a certain amount of dollars every month coming in. And you have to choose, with the help of your advisor, hopefully us, what kind of things should we put our money into that will provide the income we need today, tomorrow, next year, next 10 years, 20 years? And what kind of things should we put our money into that will give us the best opportunity for success? Meaning, what kind of things should we put our money into that will reduce the volatility of the stock market when it comes to our investment plan and our income plan? So it's a really different concept, because it says, look, if CDs were paying 10% a year, as a certified financial planner and fiduciary, I'd have to say to everybody, you really got to put a lot of money in that 10% CD. You really do, and ladder them over time. Right now, CDs are up there. They're between 4 and 5%. So that's a good thing. And we're encouraging clients, and we're helping them purchase CDs in their own investment accounts. But over time, you have to figure out, well, how do we continue our income plan to make sense to us, to give us what we need, knowing that volatility, meaning the ups and downs in the market, goes up 5% one month, down 10% another month. Well, how do we avoid that? Because it'll damage your retirement plan. It'll damage an income plan and an investment plan for you. So those are two key concepts. Keep them separate. Your income plan and retirement is key. You create that first. Then you create an investment plan that supports your income plan. That's the key to success long-term, folks. It really is. So if anything I've said here has kind of tickled your fancy, got your attention, give me a call. Again, I'm Ron Courser with Cornerstone Retirement Partners. Call me at 616-301-2581. That's 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. I'll give you a call. I'll answer your question, provide you the information you need. No cost to you. And the promise is that it'll be strictly informational. So that'll make it a little easier for you to do what you want to do. So going forward, it's important to understand these two basic concepts. And we're going to continue to talk about them throughout this program and as we go forward.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.